This episode of the Old Dogs REI Network is brought to you by Mino Studio. Mino Studio is a pre- and post-production facility for all of your audio needs. Mino Studio's founder is an accredited audio engineer with top 40 and indie album credits. With over 30 years of music industry experience, Mino Studio can take your podcast from idea to reality. Contact Mino Studio at minostudio777@gmail.com for more information. That's Mino Studio spelled M-E-N-O, minostudio777@gmail.com.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays. And if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, today we are here with Kim Lisa Taylor. We're real excited to have her aboard because she's covering a topic that for many people seems a bit intimidating. And as a real estate investor, we need to not only be aware of, but be able to do right. And that has to do with syndication. Kim Lisa Taylor, author, real estate investor, and nationally recognized speaker, is the founder of Syndication Attorneys, PLLC, a Florida law firm that helps entrepreneurs create successful investment companies. She and other members of the Syndication Attorneys team focus on helping small business owners, developers, structure and convey their investment opportunities in a way that will attract private investors, both domestic and foreign. They teach their clients how to use securities law effectively and provide them the tools and resources they need to achieve their business goals legally. An attorney since 2002, Kim has made corporate securities law her primary focus since 2008. She has written more than 100 securities offerings and numerous joint venture agreements for entrepreneurs raising money $50,000 to $100,000 or more at a time from private investors, whether from within their own network of family and friends through crowdfunding, on the internet, or from private equity joint venture partners. In addition to her work with the firm's clients, Kim is a nationally recognized expert in the securities industry and a highly sought-after speaker, instructor, and author. Well, Kim, we are really excited to have you here today. This is a great area and an area that we've been really waiting for the right person to come and explain to our listeners exactly what syndication is all about. I mean, they've heard various real estate investors from all over the place that have set up syndications and joint venture partnerships and other things that sometimes, to be honest with you, I think some of our eyes just glaze over thinking, oh my gosh, what's involved with that? And so we invited you here to help us to better understand exactly what you do and what syndication is all about. I kind of gave a bio there, but maybe you could give me a background on how you got into law, and I understand you're also an investor too, and how you put the two together and have been really focusing in this area.
Well, Bill, first of all, thank you so much for inviting me, and I'm really happy to be able to share with your listeners what I know and in the amount of time that we have about securities laws and real estate syndication, what that's all about. And I do fall within the demographic of your listeners, so I think I can relate to where they are in their investing careers because I'm right there with them. I am an investor. My husband has been a real estate investor for about 30 years, and in 2007, I went to a real estate investing event and learning how to buy multifamily apartments with him. And we met someone there that was teaching private money who happened to be an attorney in California, and I was in California at that time. And we started working together. Formed a firm, and then went on and worked together for many years, grew that firm tremendously. And then just recently, earlier this year, I branched out on my own and founded a new firm, the Real Estate the Syndication Attorneys, PLLC. So that's how I've gotten to be where I am because of my love of real estate investing and learning the techniques right alongside my clients. Learning the things that they're investing with. I've been to single-family seminars and multifamily seminars and commercial real estate seminars, just like they have. So I understand what they're doing, and I think that's helped me be a better counselor for them.
Oh, that's great. Well, this is, I think, such an important area. This is not a place where you want to do it wrong, and you really. I know that all investors listening want to make sure that when they enter into any kind of a securities focused investment, that they really need to know at least the basic. We're not going to know what you know about it, but we certainly want to be able to understand it in such a way that we do it right. And so maybe you could just kind of start real basic with us. Just kind of give us some of the key terminology that we need to know to sort of understand this.
Okay. Well, the first thing is you need to understand what is a security. And, believe it or not, there was a time when I didn't know that word either. So in the context of securities laws, the state and federal securities agencies define what constitutes securities. And if you look that up in the law, you'll see a whole big long list of things. There's really only two things that pertain to real estate investors. And the first thing is promissory notes. And the second thing is something called an investment contract. An investment contract has been defined way back in 1946 by the U.S. Supreme Court as an investment of money in a common enterprise with an expectation of profits based solely on the efforts of the promoter. So most real estate investors, when they start getting money from private individuals, are either selling promissory notes in exchange for that money. They're giving a piece of paper in exchange for the money that may be or may not be secured against a property. Or they're selling an investment contract, such as interest in an LLC or interest in a limited partnership that has been formed to go out and buy a single piece of property or to buy multiple single-family properties. So in either of those contexts, the person who's promoting that deal is the issuer of those securities. So they're actually selling securities. So when you're selling securities, you either have to get them registered by going through the process of becoming like an initial public offering, kind of like Facebook did and like Google did, which is a really long and expensive process, or you have to qualify for an exemption. So there's a number of different exemptions that you can choose, and it all depends on where your investments are, where your investors are, how much money you're raising, whether you need to advertise, and what the financial qualifications of your investors might be. So once we understand that information as an attorney, I can help you choose the appropriate exemption that will give you the best possible opportunity to raise money from investors to complete your objectives.
Now, is there the laws affect, let's say, how many people you have investing? For example, let's say I just have one person who is going to give me the down payment for this property I'm going to purchase. Would I need to draw up the same documents that I would for 10 people or 50 people?
Well, it depends on whether you're doing that as part of they call it a common plan or scheme, right? So if you're only doing that one time because you're only going to buy one house this year and that's all you're ever going to do, that's an isolated transaction, and you can probably just do that with a promissory note. But if you're in a business, your business depends on doing this again and again. Okay, so you're going to borrow from this guy for this property and then another guy for another property and maybe two people for the next property. Now you're starting to be a dealer in securities. And so now you have to start looking at those exemptions in order to be able to legally do what you're doing. The other scenario is if you're pooling money into an entity. If you're bringing in, just one investor, isolated transaction, you and this person are going to go out and jointly make all the decisions and do everything you need to do. Maybe you can just do it with an operating agreement. It's a joint venture. But when you start bringing in multiple investors, and some of those investors are not going to be actively involved, then you're creating a security. It's really kind of in the case of an entity, the question is whether the investors are going to be actively involved or if they're going to be passive investors. And then when you get into that situation of having passive investors, it doesn't matter if you have 1 or 100, you're really selling securities and you need to start looking at complying with securities laws.
Okay, so do you have to be paying interest? For example, equity arrangement that they're investing, and then when you sell, they'll get a piece of the equity.
Well, that's going to fall into that definition of an investment contract, but it could also be a note. So, in either case, it's going to be looked at as a security because you're promoting the deal and you're offering to share profits with someone in exchange for their money. So it doesn't matter if you're offering to pay that to them as a fixed amount on a monthly payment or if you're giving it to them all at the end, the instrument is the same.
So let's say I'll give you a scenario. For example, a person is, they've been investing on their own for a while, and they're kind of getting larger and larger properties. They're realizing the next purchase they're going to make is going to require way too much cash for them to be able to do it on their own. So they want to take in other investors. What's really the first step that they need to do before they even speak to anybody about what they're offering?
Well, the first thing is they have to decide what is their business model. What is it that they want to do with the real estate? What kind of real estate are they going to acquire? Is there going to be certain bank financing on a portion of it? How much are they really raising from the investors? Once they figure that out, then they can talk to a securities attorney and say, look, here's what I want to do. Let's just talk about somebody who's buying a multifamily property. They have the property under contract. They've been to the property. They've actually seen it. And they have looked through the financials. So it's a pretty sure bet that they want to close on this property. They need to talk to a securities attorney right away before they complete their due diligence so that they can get the ball rolling on drafting the appropriate documents and selecting the appropriate exemption. And so again, that's largely going to depend on how much money they need to raise, who they think they're going to be raising it from, and whether they need to advertise.
Okay, so for example, as things move, especially in today's market, things move pretty fast. And somebody, for example, finds this great property. They even get to the point where let's say they're putting down earnest money on this. There isn't always a lot of spread there in terms of time to put this together. Let's say they come to you and this is what I put down $10,000 earnest money on this great deal that I just didn't want to get away. Is there enough time realistically to be able to do what they have to do to comply for securities at this point?
Well, we always suggest that you try to get a 90-day escrow period on a commercial property with at least one extension of up to 30 days for financing contingency, whether it's your need for more time to raise the money or the bank needs more time to process the loan. So usually in a commercial transaction, you're going to have bank financing for maybe 60 to 75% of the purchase price, and then you're going to raise the difference plus your closing costs and maybe whatever you want to do to improve the property. You're going to raise that amount from your private investors. So if you give yourself a good 90 days and if you can get that extra 30-day cushion, then you'll be in good shape to do this. If it's anything shorter than that, it's going to be very difficult to get it done. It takes about 2 to 4 weeks to draft the offering documents that we have to draft, and there's a lot of back and forth in between, and we need a lot of information from the client at the same time. So there's an interactive process going on there. At the same time, you're trying to get the bank everything they need and do the due diligence. So there's a lot going on. It's a very active time for that real estate investor while they're getting that property under contract, getting their offering documents ready, and then going out and starting to raise the money. So the more time, the better.
So that offering document now, is that your private placement memorandum, or does that come later?
Well, so the offering package for a syndication would look like this. You would have a private placement memorandum. That's the disclosure document that tells the story of the investment. It explains to your investors how the company is structured, who you are, what identifies the property. You'll attach your due diligence documents to the private placement memorandum. And then there's also a large section in there about risks of investing and conflicts of interest. So the risks, it really needs to talk about all the different ways that things could go wrong and the investment could fail, so that the investors are informed of the risks before they make their buying decision. So that's the first document. The second document is going to be what kind of corporate structure or security are you going to be giving to your investors? So are you going to structure it so that they're going to pool their money into an LLC or a limited partnership, or are you going to be giving them promissory notes? So whatever that contractual document that you're going to be giving to your investors, that's kind of the meat of the sandwich. Then the other part that you need is a subscription agreement. And that's where the investor tells you about themselves and make sure they assert to you that they do have the qualifications that meet the criteria for your offering and whatever exemption you've selected. And they understand, they've read all the documents, they've asked all the questions, they've gotten their financial advice, and they're ready to invest, fully understanding the risks. So they assign that about themselves. And then the last part is that there's securities notice filings that have to be done. In the case of a federal offering, we would file a notice with the SEC telling them that you're selling securities and identifying the exemption. And then we would also have to file notices in the states where your investors claim residency.
Now, does the attorney, for example, if you're the attorney handling this, do you have to be licensed in those states that are involved as well as the state your client is based, or does it matter?
Well, 99% of what we write are under federal law, and we're allowed to help a client with that in any state as long as it's under the federal law. There are certain times when someone might choose to choose an exemption that is identified in a certain state's law, and that would be, say, if somebody is only buying property in Florida and they know all their investors are going to be in Florida, they're not going to bring in anybody from outside, then we could look at the Florida state exemptions and see if one of those might be a good fit for them.
Okay, gotcha. All right. So in putting this together, there's a certain point where the buyer has to, go out to his potential investors. That package has to be developed and finalized. Is that correct, before he can ask for any money?
That's right. That's right. They have to have the final offering package in hand before they start collecting money from investors. We like to separate it a little bit so that the investor creates what we call an investment summary. And that really just explains to the investors what it is that the issuer is doing with that investment money. And so what kind of property, where it is, what are the parameters they would use to buy. Or if they're buying a specific property, it's going to have the projections for that specific property and all the demographics and information relative to that specific deal. So they would write the investment summary, and then we would write the legal documents. So once that investment summary is done, then the syndicator can go out and they can start showing that to their investors and get them excited about the deal. And then anybody who says they're interested, then they can show them the legal documents when they're done, so that all they have to do is gather their money and get it to the syndicator at that time.
Great. Now, do you advise your clients whether or not they should have accredited investors? Who can invest and who can't get involved? And how would you work in that situation? Because I know there's now this crowdfunding, and there's so many different vehicles out there where people don't necessarily have to be accredited investors. And how do you usually move from that point as they're talking about who they may approach on this?
Well, and that's all going to be determined by the exemption that we've selected for their offering. So once someone becomes a client of ours, we will have an in-depth deal structuring conference. It takes usually 90 minutes to 2 hours, talking about what they want to do. I like to ask, what do you want to do in a perfect world? And then I try to pick an exemption that's going to give you the best ability to do that. So in that context, we would pick the exemption, and then the rules of that exemption are going to determine who can invest. So, for instance, under the federal law, there's a Regulation D, Rule 506C, like CAT, which says that you can advertise for investors, but if you do, then you can only allow verified accredited investors to invest in your deal. There's another Regulation D, Rule 506. This one's subsection B, like boy. That's the old rule. The old rule said you could include unlimited accredited investors and up to 35 sophisticated investors, but you couldn't find them through any means of general advertising or solicitation. You had to have a pre-existing relationship before you could make them an offer. So that's kind of the word-of-mouth, family and friends type of transaction that allows you to bring in people that aren't accredited. So it just depends. Most of the exemptions that allow you to bring in people that aren't accredited will not allow any advertising, except for the newest one, which is the regulation crowdfunding. That's the one where you have to do it through a crowdfunding portal, and you can only raise up to $2,000 before you have to start qualifying your investors.
Now, do the rules of exemption also specify investor amounts, or is that up to the syndicator? Like minimum amounts?
No. If you're qualifying under state laws, then sometimes they will dictate that you can't accept more than 10% of an investor's net worth, or maybe 20%. Every state, it's a little different. It, again, depends on which exemption you've selected. But under the federal law, the Regulation D, Rule 506, either B or C, there's no limit on how much an investor can invest. But you do have an obligation to vet your investors and make sure that you're not taking all the money that they have, and they will have to assert that they can afford to lose that money in the event that something goes wrong.
I see. So the time frame here is, say, a 90-day escrow, and it may take anywhere from 2 to 4 weeks. So you've maybe 1 month to put this together. Of course, also within that same escrow period, you've got inspections and other things going on, and as you're working with the seller. Do people often have to go into that additional 30 days? Can it all pretty well happen within that 90-day frame?
The first deal is always going to be the hardest. Second deal is going to be a little easier. Third deal is going to be a lot easier. Fourth deal, people are lining up to get in the deals. That's just been my experience and what I've seen a lot of my repeat clients doing. So the more experience you have, the less time it may take you to do it. But on your first or second deals, you're going to want to give yourself as much time as you possibly can. Okay,
great. Well, in this time frame of this interview, I'm sure there's a lot more that you can say that we're not going to be able to get to. But I wanted to ask you at this point if there's certain things that you'd like to sort of stress that that anyone interested in syndicating should be aware of, or other options, sort of in the same category, securities, other types of security offerings that people should know about?
Well, a lot of times my clients will choose to do joint ventures. And so the difference between a joint venture and a security, and a syndication is that in the joint venture, all of your money partners are going to be actively involved. They stay in control of their own money. They don't give it to you and wait for checks and returns. They actually stay involved. They dole out the money when it's needed. They are very much integrally involved with the decisions. So that works if you have a very small number of people. Maybe 2 to 4 people that you know very well and you're comfortable with investing with them, having them make decisions right alongside you. But it doesn't work when you get more than that, or if you're starting to bring in people you don't know very well, because you spent a whole lot of time going out and learning how to do this particular investment technique, and then somebody comes in with $50,000 and starts wanting to dictate how you're going to do things, and you actually know better in that case. So, but those joint ventures do work for smaller deals. They can get a little bit more complicated actually than a syndicate, because in a syndicate, you're raising money from passive investors, $50,000 to $100,000 at a time, and you're showing them the terms and they decide to invest or not. When you're getting into a joint venture with just 1 or 2 people, they often start taking the reins and dictating what the terms are going to be, which sometimes leaves the person who's doing the deal with a little less than they would have had if they had gone out and syndicated it with passive investors.
Now, if somebody is just going to get one person, a sponsor, for example, would there be a need for your services, or could they just deal directly with just a promissory note?
Yeah, I think that it's always a good idea to talk to a securities attorney. Again, if it's an isolated transaction, then sure, you can probably go out and have anybody draft that for you. But why wouldn't you want to deal with a securities attorney who understands all the intricacies of, what could go wrong? This is our job, and what we do is figure out all the different ways that things could go wrong and try to protect you and the investor. And because of all the experience that we have drafting these kinds of documents for other people, our documents evolve over time. No one else has documents like ours, because we change them to accommodate the real experiences of our investors to make sure that they're stronger the next time if something happens adversely.
Great. What other things do you think our listeners should be aware of if they're considering, syndicating or doing a joint venture?
Well, I get this question a lot that goes like this. I'm thinking about crowdfunding. Should I syndicate or should I crowdfund? And the answer is that you can't do one without the other. So you can't crowdfund unless you have a securities offering. So you have to go through the steps of selecting your business model and your exemption and getting the appropriate documents drafted before you can go out and crowdfund. So there's a couple of things that are called crowdfunding. One is this Regulation D Rule 506C that I mentioned. There's another thing that's called Regulation A+, and that's actually kind of a streamlined public offering that will allow you to bring in people that are not accredited and advertise to the public. But you do have to go through a pre-approval process with regulators. It takes about 6 months. There's a lot more paperwork. It's a more expensive process. And then there's the third thing that I mentioned, which is now called regulation crowdfunding, that is offered through these crowdfunding portals. With the 506C or the Reg A Plus exemption, you are able to hire a company to post your offering on their website and push it out to their groups of investors. So the crowdfunding platforms that you might have seen out there are catering to that particular market. So really, they're just offering a means to advertise your offering on your behalf. And that too is called crowdfunding. So there's a lot of nuances to crowdfunding, but the bottom line is you can't crowdfund unless you have a securities offering, and you have to pick an exemption and follow the rules before you're going to be able to offer it and advertise it to investors.
Great. Earlier on in our conversation, you mentioned also the option of developing a fund. That I would assume would be a fund that could be tapped into for various investment opportunities that may be happening in the future. Is that correct?
That's right. The fund can work when you're raising small dollar amounts per investment. So it works best unless you've just done a million, maybe you've done 5 or 10 multifamily deals, and now you're ready to go out and do a fund. That can work for you. But where it really works for at kind of the more entry level is for someone who's buying single family properties. You don't want to have to stop and go raise money for every single family property you want to buy when you've already done 100 of them last year. So you could do a fund and just say, look, here's my track record. Here's what I've done in the past. I do know what I'm doing. I want to apply the same model, only this time I'm going to use investment money to do it. And here's how that's going to generate a return for you. So that could be one of your pooled models. Another thing that works for is mobile home parks, because those are a small dollar investment. So things that don't require a lot of money to get started. There are a couple of different kinds of models that you can use for a blind pool. One is the pooled investment structure, and the other one is called the segregated blind pool model. And that's one that I've kind of been developing with several of my clients, where we can do kind of a blanket PPM, and we can attach the investment summary that talks about the kinds of properties that you're going to buy. And then when it's time, you get one under contract and it's time to raise the money, then we'll do a separate operating agreement, form a separate company to take title to that property. We'll do a separate subscription agreement, but we don't have to spend that extra time drafting the PPM every time. So it saves a little bit of time and money, and allows you to streamline the syndication process a little bit more.
Now, with the fund, do the terms have to be the same for every investor?
Usually in a pooled investment fund, you're going to, the whole idea is that you pool everybody's money into a single entity, and then that entity goes out and buys properties. And so all of the investors in the entity share alike in all of the proceeds from the properties that entity owns. But you can have multiple classes within that entity. So maybe you have one debt class that just gets a fixed return, but they get paid first. And then you have a second class that actually shares an equity afterwards. So you can do multiple classes within that.
Okay, great. One of the questions that I know is on everybody's mind that's listening, or a lot of people, is, okay, I've got this deal. I think I'm going to have to syndicate, but okay, if I'm going to have to bring a team in here to put the syndication together. People have to be able to, as investors, need to know roughly, how much they need to allocate, in their funding to be able to cover the legal fees and so forth. Is there sort of a rule of thumb that people can use in terms of as they're putting their funds together? Because that's going to have to either be in the funds they raise, or I don't know if the bank would cover that or not. But that people going into a deal need to be aware of what's going to be required in addition to the other, the escrow fees and closing costs and so forth.
Sure. Well, if you're doing a joint venture, sometimes the joint ventures can be as little as $2,500, $3,500 on up, depending what other documents you might need to go along with that, based on the exemption, based on the qualifications of those investors and how involved they're going to be. But for a full syndication offering package like I described, you're probably looking at somewhere between, our fees will start around $12,500, but you should be budgeting around $15,000, because you're going to have some associated costs with filing, forming entities and filing state securities notices. Each of those have a fee. So, you should be budgeting, $15,000 to $20,000 for a full-on syndication. If you're doing that segregated blind pool model, then your subsequent offerings can be much cheaper.
And when you sit down with your clients, obviously you're looking at what's going to be the best approach for them. Whether it should be the pooled, like you mentioned, or one of these other types of vehicles. Is that correct?
That's right. The trouble with blind pools are deal flow, right? If you're going to raise a pile of money and you have it all sitting there, then you need to get it working right away, or it's diluting the returns to the, so you really just need to have enough deal flow to get that money working as quickly as possible, unless you're going to be raising the money as you need it, kind of in that segregated business model.
Now, this is going to be, I'm sure, a dumb question, but I'm real famous for those. With a pooled fund, do you have to pay the person, regardless of whether or not those funds have been invested, in terms of what the agreement is when it was set up?
Well, again, I'm an attorney, so I have to answer those kinds of questions with "it depends," right? It wouldn't be a successful conversation with an attorney if I didn't think.
Of course.
Right. So it always depends. We can set up rules in the offering documents that say, the money will be left in escrow, and while it's in escrow, it's not earning any returns. And when it's converted out of the escrow account into the operating account and applied to a property, then at that point it begins to return. But generally, investors aren't going to want to leave their money in an escrow account where it's not earning anything for more than 90 days or so. So a lot of times we'll just write a rule that says no returns begin to accrue until 90 days so that the syndicator has time to get that money working.
Right.
All different, this is where the customization comes in. I like to say that all of these offerings are exactly the same but totally different. So we go in and we customize each one for what's right for that syndicator and their investors.
So if you've raised $10 million from 100 investors, but let's say you've only actually utilized $5 million, I would assume the documents would explain who gets paid and how much. I guess everybody has a percentage. Is that how that works?
Yeah, everybody owns a percentage interest in the company, and at the time the distribution is calculated, that's what dictates how much they get paid. You might do some proration in the beginning for people that come in later, but it becomes very complicated if you try to carry that forward. It's like, if I own Apple stock, I get paid based on the stock that I own at the time the distribution is made, not, looking back to see when I bought it.
Right. Well, Kim, I could ask a million questions, and I'm sure that there's a lot listening that are saying, Bill, why didn't you ask this question away? There's like a lot of things. I want to sort of wrap this up so we can, get ready to close out because our time frame here. But at the same time, I want to give you an opportunity to maybe address anything that you might have left out that you think people should be aware of.
Get good securities counsel. Don't be in denial. A lot of people that I meet, especially at local real estate investment clubs, are in denial that what they're doing, I'm just selling promissory notes. I'm not doing securities. Well, you heard it today. Those are securities. And now what's going to happen is everybody that listens to this is going to become securities police, right? Because they're going to be able to go to their local RIA. And I can go to any local RIA any time and I can find someone breaking securities laws there. Thankfully our regulators haven't figured that out, so they don't tend to show up there.
Wow. Well, now they all know, so they're listening to the show here. But no, wow, yeah, that's one of those areas, where I just advise everybody listening, be cautious, go to the best you can find that really, it's worth it. And, some of the folks that referred me to you, one of them actually was a guest on our show, Vinny Chopra. And he basically said, when you're doing these types of investments, when you're talking, tens of millions of dollars, you do not want to make mistakes. And that's why he feels, he went to the best. And so I take that as a very high recommendation for you. But I'd say it to anybody if you this is not an area you want to necessarily look for your Uncle Louie that he's dabbled a little bit or something. You want somebody that specializes in this.
Well, the main thing that people tend to do is, sometimes they'll get somebody else's documents and think, oh, well, I'll just copy those. And, there's so many nuances and so many cross-references, and, you fix one thing in one place in the document, it affects two other documents and three other places in that document. And if you just don't know that and you don't understand those nuances, you'll never figure that out. And so, it's not a do-it-yourself area of the law, and it's very dangerous to try to do that. And the other thing that people don't understand is that, if you do it yourself, it's not just documents that you have to generate. You also have to do these securities notice filings, and it's kind of a convoluted process to file this Form D with the SEC, and then also to get your state securities notices filed and making sure that you get them filed in time so you don't lose the exemption in that state. So, those are the kinds of things that an experienced securities attorney can help you do. The other thing that people do wrong a lot is they create adverse tax consequences for themselves and their investors because they don't understand the difference between, structuring it this way versus that way, and they can have completely different tax consequences for everyone. So experienced securities counsel can guide you in that as well.
Oh, thank you so much. That's well said. Well said. Well, this is the portion of our show we call it the Wrap It Up section, where I ask you a series of quick questions, and you can share your response. And I have 4 key questions that we ask, and I will start with the first here. Your favorite real estate book?
I think Emerging Markets by Dave Lindahl. If you're buying multifamily, that's a must read.
Good choice. Favorite business book?
Think and Grow Rich.
Oh, good. Most valuable website for success that, again, we say other than your own, that you tap into, you think any real estate investor should know about?
Well, I think if you're going to be in this industry and you want to learn about crowdfunding, I'm not sure that there's any one website I would say is any better than the other, but get familiar with crowdfunding companies and understand how they work. Because if you want to be able to tap into a larger resource than just the people that you know, then you're going to need to understand crowdfunding. And there's a number of crowdfunding platforms out there that can advertise your offerings. So you might want to get to know those folks and get to understand what they're going to need from you before they would agree to advertise your offering.
Would you mind maybe volunteering one or two? Or
sure.
You feel, have maybe your clients have worked with and you feel are good, good places to check?
Absolutely. Crowdstreet.com is one of the ones that's helped several of our clients raise significant amounts of money. And RealCrowd.com is another one. Realty Mogul is a different type, but also very much a player in the field. And then another type of company that you might want to look at fundamerica.com. Fundamerica is a broker-dealer that will act as a transaction broker-dealer for your securities offerings. And this offers you another layer of protection between you and securities regulators. And I highly recommend that you check out their services. And then they have some very interesting things to offer. But sign up for their newsletter because they offer very informative information about that.
Great tip.
Mm-hmm.
Yeah. How about your favorite app?
Oh, gosh. Well, it's not related to real estate.
Snapchat. No, just
Word Warp is by far the thing I use the most of any. As far as a real estate app, I can't say that I actually have a favorite.
Doesn't have to be real estate. It can be just one that helps you do whatever you do better. Word
Warp helps me get through the day, when I need a break.
I love it. Well, great. Well, how can people get a hold of you? And I'm sure there's plenty that that want more information, or may even be in the middle of a deal or approaching a deal, that would love to be able to contact you.
Okay. Well, my email is kim@syndicationattorneys.com. And my phone number is 904-584-4055. I do offer free initial consultations. If you go to our website at syndicationattorneys.com, there's a place to request a free consultation. And also, we have a newsletter that goes out once a month. So if you sign up for our newsletter, we are going to be offering free once-a-month teleconferences where we'll talk about a topic and then also leave some time for Q&A. So if you have some securities legal questions, then you could get on that call and get those answered for free.
Wow, that's a great tip. Thank you for that. Yeah. Mm-hmm. Well, the last part of this is, I don't know if you read your cover note here, but we're called the Old Dogs REI Network, and all of our guests that have been on here closed out the segment with doing their best old hound dog howl. And you're out in Florida, so I don't know how many hound dogs are out there, but you could probably do a gator howl or something. But no. But so just we're gonna close it out with you doing sort of your best howl. Are you ready for that?
I am. I used to have Alaskan Malamutes, and they did the best howls ever. So I will do one for you.
All right.
Woo!
That's great. Great, Kim. Wow. That was that's going to be tough to top that one. I know this is one of those moments, when all this great information, you just pretty well threw away your credibility. No, I'm just kidding. No, actually it was really good. And that's going to be tough to top for some of our other guests that are going to also have to do the same thing. Well, Kim, I cannot thank you enough. This has been a great conversation. And like I said, I feel we probably just scratched the surface of the content that you could provide us. And so I'm going to, say I would love to have you back at another time and maybe expand on some of these other areas or address some of the questions that we didn't get to address in this conversation.
I would be happy to come back, and thank you so much for having me on. I hope the information was useful, and I hope all of you think about securities laws as you go out and raise money from private individuals, because we don't want to see anyone get in trouble, and that's really my main focus.
Great. Well, also for our listeners, keep in mind that everything we discussed here is going to be summarized in our show notes, and we're pretty thorough on our show notes. So we have got a lot of information in there, including Kim's contact information. So I hope you're not driving trying to write any of this stuff down here, that you can be sure that you can go to olddogsreinetwork.com and look in the blog section, and you'll look it up under this particular podcast, and all the information will be there, including the links that she mentioned as well. So, gosh, thank you so much. I cannot thank you enough for sharing that information. I think you really enlightened me a lot, and but definitely got me thinking more things. So I've got a lot of new questions for the next time you're on. So I thank you very much. For those of you that are listening to, I would recommend that you go to her website. Definitely get that newsletter. I mean, that's got to be a incredible value, and being able to join those webinars is fantastic. So you can educate yourself on syndications and those more advanced funding options that we hopefully will all have to deal with as we expand our real estate investing. So for everybody listening out there, we want to thank you for listening. We know that you could be doing a lot of other things right now, but the fact that you're listening to the Old Dogs REI Network certainly means a lot, and we thank you for that. And we just hope you move forward with your investing, keep learning, and we'll be seeing you down the road. God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.